To start 2025, I did a video about Taiwan Semiconductor stock, and I took the stock off of my list of stocks to buy. For 2024, I had Taiwan Semi rated as a buy, but for 2025, I downgraded it and rated it as a hold. Now, if you listen to that recommendation, you will have saved some money. The stock price started the year around $200 a share. It's now down to $170 a share. So it's down about 15% year to date. Does this make it a buying opportunity? Well, I'm going to revisit Taiwan Semiconductor stock now, given the lower price, given the changes in geopolitical factors, given all of those things that have changed for the semiconductor industry, and given updated recommendation for Taiwan Semi. So let's get started.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So I want to start with looking at the company's revenue growth, which is doing very well. The company benefits from the rising effectiveness of artificial intelligence. If you didn't already know, Taiwan Semiconductor is the manufacturing partner for companies like Nvidia, AMD, Apple, and even Intel outsources some of its manufacturing to Taiwan Semiconductor. The expansion in the data center business optimized for artificial intelligence is booming, and Taiwan Semi is benefiting from that. Taiwan Semi is also benefiting in recent quarters from what's going on in the smartphone market. Now, the smartphone market is not growing in terms of unit sales, but what is happening within the smartphone market is people are trading up for more powerful smartphones embedded with more technology. And of course, that's good news for Taiwan Semi because that means the manufacturers like Apple are spending more money going for the latest generation, opting for the higher average selling price units that go into these smartphones. And so it's going to benefit from these trends for many, many years to come, especially the data center segment optimized for AI. Taiwan Semi is also one of the best manufacturing companies in the world in any category, right? So it's a semiconductor manufacturing company, but you can compare it with car manufacturing companies, computer manufacturing companies, and you'll scarcely find a manufacturing company that generates operating profit margins over 45% like Taiwan Semi does. And to make that even better, the company's been expanding its margins for the previous decade, started at around 38%. It's now closer to 46%, and it's dominating the industry. It's making it very difficult for companies like Intel to regain a foothold in this industry. Now, there is one factor that's going to bring down its margins, and management talked about the diversification of its business. Formerly, the vast majority of its manufacturing footprint was in Taiwan, but the last couple of years and all of the elevated geopolitical tension has made it a priority for Taiwan Semiconductor to diversify its manufacturing base, and it's expanded outside. It's begun producing chips in the United States, and it's making an expanded investment in the United States. It also built facilities and is building facilities in Japan. And the management team said that these investments are necessary given the geopolitical environment, but also saying that it is more expensive to produce outside of Taiwan. And so that will have the impact of bringing down margins a couple of basis points, a couple of percentage points for the next couple of years. Still, I think that was a prudent move for Taiwan Semiconductor, especially now we're seeing the incoming administration. It feels like they are less interested in getting involved in disputes outside of the normal operating environment of the United States, and the United States had been a major deterrent to the tensions between China and Taiwan. So bigger question marks there, raising the level of riskiness for Taiwan Semiconductor stock for factors not related to its business, but factors related to geopolitics. Now, the semiconductor manufacturing industry that Taiwan Semi operates within is a very capital intensive industry, perhaps one of the most capital intensive industries, where Taiwan Semi regularly spends over $30 billion annually on capital expenditures, and that figure could rise closer to $40 billion. The good news is it generates good returns on those investment. The 25% return on invested capital is a really solid number for Taiwan Semi. But as per usual, I compared the ROIC with the WACC. And Taiwan Semi has a relatively high weighted average cost of capital because of the factors I mentioned in the video: the high capital expenditure requirements for its industry, and the geopolitics within the region. The company's beta is higher than usual at 1.27. The market risk premium I've applied here is 8% instead of the usual 6% that I apply to US based companies. And so that elevated risk is incorporated here in my weighted average cost of capital, which also weighs on the company's valuation. So the WACC at 14.73, what's good is that it's lower than the ROIC at 25%. So it does generate higher returns on invested capital compared to its weighted average cost of capital. And that means it's increasing shareholder wealth by deploying capital. So every time it spends $30 billion, so long as the return on that invested capital is higher than the cost of that capital, it's adding shareholder wealth. I hope that makes sense. If there's any questions, please ask in the comments section below. I love to answer these types of questions. The valuation is getting increasingly more attractive. It's now trading at a forward price to earnings of 16, which is around the levels it was trading at to start 2024 when I had the stock rated as a buy. However, measuring by the discounted cash flow valuation model, I come to an intrinsic value per share at $154 compared to the current market price of $172. So, in conclusion, Taiwan Semi is a fairly valued business according to my calculations. Usually, what I say in these scenarios where you have a fairly valued business, that is also an excellent business, right? I talked about how Taiwan Semi is arguably the best manufacturing company in the world. Usually, when I see a fair price for an excellent business, I will rate that as a buy. The only reason I'm not doing that in this case is because of the elevated risks around the geopolitics right now and the uncertainty. I would require a higher margin of safety in this current scenario. So that's what's keeping me from increasing the rating for Taiwan Semi. So I'm going to keep it rated as a buy. I'm updating that today on March 7th. But this is a company that I'm very interested in, and I will be following and updating more frequently. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.